Okay, so part two of chapter 12 for investments. We're going to start talking about industry analysis. So first thing, we have codes that define the different industries, and we classify them based on what they do. And so we can put them, basically it's just something to categorize and group them into groups. So I can say, okay, everybody in this industry is having this problem, everybody in this industry is feeling this. So that's a method that we use. NAICS codes are the codes that are kind of nationally used to identify different industries. Makes it really nice to go through data too that way. Sensitivity to the business cycle, sensitivity of sales, operating leverage, and financial leverage. We can look at a lot of different things. These are just a few options. But these are a lot of things we can look at within the NAICS codes to see how certain industries react and how they do based on the economy and based on the business cycle. Well, here's just some examples of codes, and notice there's an overall code like construction as a whole, then construction building, and residential building, and then so on and so forth, and as it goes down. So all of them have the starting point of 23, all of them have 6 because they're all construction building, and then so like I said, it continues to go. Obviously 1, it looks like means residential, 2 means non-residential or industrial. So that's just an example of the NAICS codes. What industries had the highest return on equity? Aerospace, very high return on equity. Broadcasting, clothing, computer and electronic, transportation equipment all had some of the highest returns on equity. Yeah, these are the greatest return on equity to the least return on equity based on categories. Industry stock performance in 2016, you can see the aerospace is still up here. But then you can see heavy construction, oil and gas, pharmaceuticals, food products did not do so well. So this is the industry stock performance from 2013 versus 2016. So you can see a pretty large difference between, say, how aerospace and defense, here is at what, 55% or so. Here it's at 27, 28. Banks and money centers. You see that one over here. Banks here, substantially less. So you see 2013's returns compared to 2016's returns. This is a return on equity for specific software firms. Intuit, they make QuickBooks and other accounting software. They make more software than just accounting, but they definitely make accounting softwares. So does Oracle, so does SAP. And obviously, probably ones you've heard of more, Microsoft, Adobe, and all these, and Symantec, all the software firms. And this is their return on equity. Okay, so this is cyclicality growth in sales years. So annual sales growth is on this vertical axis. So here we got the annual sales growth. And the years 1993 through 2017 is on the horizontal. Excuse me. So jewelry, we got jewelry and groceries here. Jewelry starts way above, and then trends down, and goes back up, and trends down, and goes back up. You can just about see that grocery tends to just stay between 0 and 5 the whole time. And this, if you think about it, this kind of makes sense. Jewelry is something you don't necessarily need. Jewelry is something that you do usually when the economy, or buy when the economy is doing well. Generally not buying when the economy is doing poorly. You can quite literally go through here and pick out some of the recession areas. In several charts already, we've seen the early 2000s recession. We certainly have seen the 2008, 9, 10 or so recession, which you can see in the jewelry graph here too. And you can see that you're seeing dips in grocery as well, but you're not seeing as large of a dip, and you're never seeing it go below, never seeing it dip below 0. So this has a much larger, jewelry has a much closer relationship with the economy, and it tends to move in larger swings, whereas groceries moves in smaller, more incremental movements, and never goes below 0. The business cycle looks a lot like the economic cycle. So we got peak contraction, trough expansion, and we got our economic activity and time. Something that happens within a business cycle, though, too, is we have the business itself as well as products that move through a cycle that we'll talk about here in just a second. Sector rotation, industry analysis. So shifting a portfolio into industry sectors that are expected to outperform. So, you look at some of these return on equities and other numbers that we just went through, and you could go through and pick out certain industries that do well or poorly. So something that a lot of investment finance individuals do is they look at forecasts, they look at the economy, they look at some of those economic indicators we talked about before to make a decision as to what industries are going to do what and how well or poorly they're going to do and what that performance might look like. So shifting a portfolio, if it's expected to outperform based on the macroeconomic forecast, after peak, defensive industries often are better performers. In the trough, we usually use capital goods industries. They're often better performers. And expansion, we use cyclical industries. So, after peak, we'd want to be in defensive industries. That would be aerospace, would be one example amongst others. In the trough, with capital goods, we'd look for things that is required, even things like groceries and stuff to kind of outperform others. And expansion, to go back to the last chart, we could use jewelry and other things in that industry that follow and quickly rise up when there's an expansion. So here's some just an economic sector rotation of what it looks like and what's best in expansion and contraction. And then also, this is not just twofold. You also got to look at these ones that are outlying on where the actual arrow is, like energy and healthcare here, would be ones you'd want to be invested in if you think we're moving from one to the other. So if we're moving from an expansion to a contraction, you might very well want to be invested in energy and healthcare. If we're moving from a contraction to an expansion, you might want to be invested in technology and consumer discretionary funds or discretionary purchasing. So industrial life cycle, and also this works for product life cycle. The startup stage, often characterized by a new product, technology or product. After that comes a consolidation stage where industry leaders begin to emerge. Then there's the maturity stage where product reaches potential for use by consumers. And then the relative decline may grow less than the rest of the economy and shrink. So this is what that looks like in graphic form. Now, what's interesting about this is the rate at which that a product or a business moves through this is different for all kinds of products. So for example, I think I want to say Ivory body wash, or one of the soaps, has been making the soap the same way since like the late 1800s. So they've been moving, and they're probably over here in this minimal growth phase. So they've been moving through this product life cycle for 120 years. But then you look at something like, if you do a product life cycle rather than a company, you look at something like a phone, and it probably moves through this cycle in a year or less. So while all products and businesses and companies run through this process, it's not uncommon for certain products and certain companies to run through the process much faster than others. So another example of one where the industry was disrupted and people came in and took over. So you had like Blockbuster and all the video rental places that back when they started, back when VHSs became a big thing back in the 80s or so, roughly, they were the startups, and then they started growing larger and larger, and they had stable growth, and they were getting mature around the late 90s, early 2000s, and then all of a sudden Netflix came in. Well, first Netflix was just somewhere where you could get DVDs by mail, but then they became streaming. Well, that moved Blockbuster and all those other video places all the way over here into decline. And as a matter of fact, you could take this line out a lot further and show their decline because they went all the way out of business. But then you got Netflix and those other ones that are right probably here in the stable / slowing growth area of their life cycle or industry life cycle currently. Industry structure and performance. The threat of entry, new entrants and pressure to price profits. The easier it is for people to get into your industry, the more pressure there is on pricing and more pressure there is to compete to the point of not wanting, of making it so that others don't want to get into your industry because they can't compete with you. Rivalry between existing competitors, market share, competition, pressures, pricing, profits. So when you have competition between people, that's usually better for the consumer. For businesses, it can get rough because you can pressure in good competitive environments, companies will pressure each other to change their prices and other elements, not just prices, but services or the product itself. They need to innovate, they need to change. When you're selling the same thing as the person down the street and they can sell it for either cheaper or the same price, then you don't really have a distinctive advantage. There's other ways to add value outside of just monetary factors, but generally speaking, that's the case. Pressure from substitute products, so pressures in related industries that can threaten the market share. So if you're selling one product and there's something that can replace it or do the same thing, but it's a different product, that also can affect an industry, affect your pricing, and affect the economic elements of that industry. Industry structure and performance, bargaining power of the buyers. So large scale buyers have considerable bargaining power. If you work in an industry where you're buying large quantities of things at a time, you typically have much more power in that. And so this is something that large companies like Walmart and Target and Amazon use, where they can buy things for a lot cheaper because they can come in and say, I want to buy 5 million of these things, rather than saying, I want to go buy 500 of these and sell them. Well, that seller is going to be more likely to give a special price or better pricing to a larger quantity than they are to the smaller quantity. And suppliers, similar. They also can, large scale suppliers also can have considerable bargaining power too on the other end. So this is just a table of the different economic calendars. And that's it.